Here we go, here we go, here we go, here we go. It's markets in the afternoon with the Federal Reserve interest rate hike. Here we go. Hey, what's going on, everybody? This is the blockchain backer, bringing you the latest cryptocurrency news and analysis. Today, it's Federal Reserve interest rate hike day. It's FOMC day. We're going to be watching to see how the markets do react as we are about to get a release of what the interest rate decision here is in the next 4 minutes. So if you are tuning in and watching the replay of this, you can skip ahead 4 minutes from right now, maybe 3 minutes from right now, and see what the reaction of the market was as the interest rate decision was released. And then if you want to skip ahead 33 minutes, that will be when Jerome Powell is speaking for those who are on the rewatch. As for us who are watching live today, right here, I've got the Dow Jones pulled up on the top of the screen. I've got Bitcoin down here on the bottom of the screen. And we're going to see what the market does right when things happen. So today it is expected that we are going to see a 25 basis point rate hike, or a 0.25% increase to the federal funds rate, currently sitting at 5% to 5.25%. It's expected that it will be raised to 5.25% to 5.5%. We see the 2-year yield and the 10-year yield have still not been able to catch up to where we've been at for months, but it is anticipated that we are still going to see an interest rate hike at this meeting and in this announcement here in the next 2 minutes. Currently, as we head into this right now, we could see that the stock markets are wobbly. We see the NASDAQ is down 110 points. The Dow Jones is about even, and the S&P is down about 0.25%, about half stocks green, half stocks red. Over here in the cryptocurrency market, we've got some green over here and more red, but some green. Bitcoin is slightly in the green right now. So the rule is, if we, at the end of Jerome Powell's conference, if we've got a bunch of green, we go, we play the frog. If we don't have a bunch of green, we don't play the frog. So right now we are approximately a minute and a half away from getting the interest rate decision. So I don't know what's going to happen with markets on this. I have no idea how it's going to react. I'm not going to be able to do any technical analysis or any real big thoughts on it when it happens. I'm watching it just like you are, seeing how it's going to happen. So the way we're going to do this is we're going to watch the rate come out. We'll see how markets react. I'll yap my mouth for about half an hour hanging out with you guys in the chat. Then when Jerome Powell comes on, I shut my yapper up, we watch, and then once he's done, we kind of just wrap it up and it becomes a conclusion. Even if the market is super green, or if the market's super red, or if it's flat, we just kind of wrap it up at the end of Jerome Powell's press conference. So, and that will be in approximately 30 minutes from now when Jerome Powell does speak. But as of right now, we are about 30 to 45 seconds away from figuring out what the interest rate decision is going to be. So here we go. I can't do the frog. Gavin Brooks says, do the frog. We only do the frog if we end the day or end Jerome Powell's meeting super green or at least green. Geez, it's been boring the last couple of times, but I do not know how the market will react. And a lot of times, get ready, guys. Sometimes our first reaction is not it. We could pump up and that might not be the right thing. We could dump and it might not be the right thing. The market could be very volatile. So let's go ahead and start hitting refresh over here. Press releases. Nothing. Let's go back. There it is. FOMC statement. What's the initial reaction to the market? I'm looking at Dow 449, 448. Expanding at a moderate pace. Raise the target to 5.25. So they did raise by 0.25 point. All right, let's see the market's initial reaction to the raising of 0.25 point. Really quick. So we did get a 0.25% interest rate hike. Let's see what is happening over here with the US dollar. Always fun to see what these things do on the 1 minute chart at these exact moments. You see dollar moving down. Notice that it did pump slightly leading up to the statement and then turns itself over. We can see stock market turning slightly green. Bitcoin still remaining relatively flat. All right, let's go ahead and read the press release. Recent indicators suggest that economic activity has been expanding at a moderate pace. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 5.25% to 5.5%. The committee will continue to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags of which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in its previous announced plans. The committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance on monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goal. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. I know that the meat of it, the thing that Jerome Powell always points to, is the wording that is used in here. So it says the committee will continue to assess additional information and its implications for monetary policy. It's not that. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy. I know that's the one that always matters. I don't know why. And the wording is always so slimmer. He's like, I always want you to focus on the word may. Notice that we didn't include the word may last time. It's always like that. In the meeting, he points to one word, and it always comes from this section right in here. So we'll see what he has to say when they do go when Jerome Powell does speak. Looking at the markets, though, they look relatively unchanged as we have the rate hike. Why would that be? Likely because the market correctly priced it. The market really had no indecision on that there would be a 25 basis point rate hike or a 0.25% interest rate hike. Really right on par for what the market did expect. We can see the dollar a little bit of wishy-washy here on the 1 minute chart. 1 minute, right? But even that range, that's pretty tight. That's not really a whole lot going on there when we zoom out to the 1 hour, right? No trend change, no break of anything, no significant supports broken, no significant resistance is broken. Totally just right there within the same range it's been in with them for the last 2 hours. So I would call that a non-dramatic result. Same thing goes for crypto. Same thing goes for the Dow Jones. I would say it was a very non-dramatic reading that came from the Fed, which I think we'll take. So, okay. Because you could see over here on the bottom left of my screen, I do have, this will be the press conference. So when the press conference does go live, I pretty much will just go like this. And then I'll put myself on mute. And then we just sit here and watch this thing for 30, 45 minutes, however long it goes. We'll listen to Jerome Powell do a lot of hard swallows. But hopefully he gives us some type of information. Somebody asks a good question and something happens that the market is like, yay. And our market is like, yay. But we'll see if that ends up coming. Otherwise, as you guys probably noticed, I was able to schedule my stream. I got it started on time. Not really. I scheduled it for the time I was supposed to, and I did actually go live right on time. But it turns out I needed to input a new stream key, which was unusual. So I actually did go live, but I was talking into open space and open air. No one was there. I had to cancel the other stream and start a new one. So that was just kind of the learning process. But I did learn it. There was a reason why I was 1 minute late. But all right, let's go ahead and hit the like button, guys. I'm going to jump into the chat. Now we're pretty much just going to burn time. We're pretty much going to burn time for the next 25 minutes until Jerome Powell comes up. What we can see right out the gates currently is there's no significant market reaction. So leading up to it, though, all indexes were pretty red. We still have the NASDAQ quite red. About 0.75%, or excuse me, 0.2%. The S&P is down about 0.25%, and then the Dow Jones is sitting just about flat. So not really a big change pre or post. No big change in really anything. Nothing. Not in metals. I mean, gold was 1969 prior to the Fed announcement, and it's still sitting at 1969. So really, others heard you also. Wait, did that stream go live? Gary Gensler. Triple, you got to triple click it, Gary. Dang it. How much can I deadlift? The last time I tried was 307. And I did do 307, but I haven't tried more than that. And I know that's not a huge number, but 307 was the last time I tried. I mean, I deadlift like 3 or 4 times a week. For the last time I tried a max, it was 30 something. All right. So, we're going to pretty much burn time now. We have 23 minutes till Jerome Powell is supposed to go live. So when he goes live, we'll pull that up. So I'm going to hide this just for a second. And then I'm going to try to refresh this page and see if that does anything. Yeah. Okay, cool. That is now live. We'll go ahead and turn that back on. Looks good. I had to mute that. They play their music. All right, let's hop in the chat. T, we could hear you on the other stream just fine until you turned it off. No kidding. I didn't see any of you guys saying anything. So I was like, oh no, I messed it all up. Here, we're gonna have to move this guy. There was some smooth. There we go. Put you over there. Some smooth people during the last one. Like, look, I'm on Jerome Powell's face. Hugh Donnelly says Biden and UFO hearings, good distractions today. Yeah, I'm a math and statistics type person. If there are billions and trillions of planets and suns and solar systems and all that good stuff, mathematically speaking, it seems highly likely there is life on other planets, and highly likely that there is something smart enough to be able to leave its planet. Question is, has it been here? And if it has, how has it stayed a secret this long? And how come all of us have all these cell phones and nobody is capturing like indisputable epic evidence? Why are we not getting any of that? So that's my only problem. I think, I've always been like a huge UFO guy, all about it. But I think a problem I have had these last few years has been like, dude, we've all got these 4K cameras. Why are we not getting all these 4K shots of them? So, all right. Through so those who are just tuning in, we did see the 25 basis point rate hike to the federal funds rate. Let's take a look over here. Let's go to U.S. 10-year. No real reaction in rates yet. So you would think you would see something happen in the 3-month, the 6-month, the 2-month, but there's really no reaction happening there in those. So we'll see how those pan out. Stocks are starting to kind of slightly recover here a little bit. The indexes are slightly recovering as they were kind of a little nervous heading into that. Looks like they are starting to turn back up. You can see we were drifting down in the indexes leading up to that moment. There has been this little pop here in Bitcoin, but we need to see a more significant move. Otherwise, we've been holding here for 2 days. As we all know, we're on top of the 50-day moving average. So just sitting here and waiting. Big Shroom says there's a bearish divergence on the daily NASDAQ and S&P, but not on the Dow Jones. Maybe. This is the daily time frame. I don't see significant bearish divergence. You could say slight. I wouldn't. This one. Oh, maybe this one. Slight. I mean, you got to be a little nervous. I mean, price is just up, right? Pullbacks are going to be common, but I don't see anything screaming that like it's gone way overbought and then now it's setting new highs on significant bearish divergences. I don't see that screaming in here. Steve Sokolowski, welcome, man. New member. Somebody said, why is XRP pumping? We all have different definitions of what pumping and dumping is. I have learned throughout the years. I have learned that to some people, this is pumping. And I've also learned that a fall of 1/4 cent is dumping. I don't even know if it's 1 cent, but you know, hey, whatever, man. We'll take it. So where we're at right now is that the Federal Reserve did do the 25 basis point rate hike, 0.25%. We are seeing markets doing okay right now. We're seeing crypto. This might be the most. Actually, XRP's in the green today. That's actually the first time. Why? Mr. Pineapple 94. Why is XRP mooning? That's the first time XRP has been green today. So there we go. We've got quite a bit in the green. Easy peasy. XRP just flew over my house. So, all right. So at this point right now, we've got 17 minutes until Jerome Powell will come on live. And then we'll watch. You're going to have to excuse me. Barker 2.0. All right, 17 minutes until Jerome Powell comes up. Alberta's Cowboy. Man, thank you. My T-Swift experience, Craven County, Jamboree 2008, and I was 17 years old. It was $100 a ticket. She wasn't even the headliner. Played before George Strait. She had a bucket of water dumped on her for effort. She mouthed, "That was cold." Wow. I think one of the crazy things is like she's on pace. You know, you got to pay respect where it's due. She's on pace to like outperform the Beatles in regards to record sales and in regards to concert sales. That's pretty crazy. Man, Dennis Wayne. Wow. Thank you very much. I watch her content every day and it's the best out there. Thank you and keep being amazing. Dennis, thank you very much, man. Wow. It was very generous. Thank you, sir. Momentum Dongle. Do you actually talk like this, or is this a character? I don't know. I think you probably do develop a little bit like a radio voice a little bit. You know, you kind of make sure your throat's clear and you're talking good into the mic, but I don't know. I think so. Oh man, it's soaring. It's at 71.2 cents. Yeah, BC Barker stole the show. He's over there. He's barking at people outside. Dennis, thank you very much. Alberta's Cowboy, thank you guys. Appreciate it. So we've actually, guys, if you're looking over there on the right side of the screen, nearly everything on that screen has gone green. Now, and if you've been watching the markets all day, like everything's been red. Man, could you imagine if we got like some 10s and some 15s over there on the right side of the screen? We're frogging it up at the end of this thing. I think it's been 6 months since we've done that. Now for Powell to mess it up. Maybe, maybe, right? You can never trust it right here. This is totally untrustworthy. Once Powell gets up, things can totally flip and flop all over the place. Yeah, finally, the non-news we've been waiting for. Pretty much, right? It was exactly what the market expected. Yeah, XRP Preacher finally made it. Set it up before it went. Do you hold XLM? I do hold some XLM, but my total holdings are approximately compared to XRP, it's like 5%. So let's say I own, for every 100 XRP I own 5. For every $100 of XRP that I own $5 worth of Stellar. So that's how big that position is. BCB, what mic setup do you use? This is a Shure. I don't know if it's an M7 or what it is, SM7, something like that. And just so you know, you don't need anything fancy to get started. For my first 2 years, I just used a headset. What was I using? I'm using this thing. HyperX Cloud 2. Seriously, first 600 videos on this channel are on a HyperX Cloud 2 $69 headset with a built-in mic. Jerome, welcome. Thank you very much. Welcome. Oh, geez. Save, who thinks BCB should get a pet frog for the Wednesday streams? Man, I do not want any frogs. Maybe I'll get one of those frogs you can put in a fish tank. I do not want to take care of any new pets. The ladies of this house are always like, oh, could we get this dog? Oh, could we get this cat? I'm like, we already have pets. I'm like, yeah, but we need more. I'm like, no, you don't. Who's taking care of them? And the last time they came home with pets were these fish. She came home with a 3-gallon fish tank with 5 fish. Guess what? I now have a 75-gallon tank. I'm the one who takes care of it. So, all right, we're bouncing around, but we do have more green. I would say we don't have substantial green, but we are in green now over here in the market. Bitcoin's nothing huge. Look at that, it's almost flat. I'd call it relatively unchanged and say that the market has been unreactionary, except slight green. I don't even think it's probably more than a 1% move in most of these coins, but it's just that they were barely in the red, so now everything's in the green. But you know what? The green is appeasing. We can see the Dow is starting to recover, right? We can see the DXY unchanged. Right, let's go back to that 1 minute chart. Really? Well, I don't know. We'll see. Nothing though, right? Still range bound from the whole day. But Dow, maybe. We'll see. I don't think it's definitely hasn't had anything. This is the pre-announcement drift. There's the announcement, and now we're back to where we were pre-announcement. So I don't think anything really substantial has happened just yet. And we will have Jerome speaking in 10 minutes from right now. Cash me outside. Remember 3 months. What's up, brother? It says don't get a frog and put it in the fish tank unless you want mass population control. Also, hit the like button and shout out to the crew. Much love. There are frogs, though, that you can put in fish tanks. There are these little frogs. My brother-in-law got some. Andy Philpott with the Super Six. Wait for it. Mr. BCB, drop a beat. I can't do it, man. I only do it. And we'll get rowdy. We can get rowdy as long as it turns green at the end. That's always the rule. Otherwise, it's not special. So it makes it like super special if it does happen, because it's actually only happened one time. Out of all the times that we've done this, it's only happened once where the market is like super green after we got through Jerome Powell. In that one time that did happen, we actually got like a pretty nasty sell-off right after the rate hike, and right at the beginning of Jerome Powell, we got like a nasty sell-off, and then like halfway through the press conference, whoop, everything turned back up. And then like took out the daily highs. Oh yeah, you guys, there you go. Jerome T's got it. He's got it, man. Thank you, Jerome. He says, I've been following you for so long, but I was lacking in membership. I'm sorry, mate. But Powell can now finally announce the Fed XRP buyback. Just kidding. Keep it up. Thank you, Jerome. Gator, my man, gifted 5. Gator, I appreciate it, brother. Thank you. And Hambo Commando is a new member. Thank you. Along with Rodney. Thanks, guys. All right, so we are now 8 minutes away from Jerome Powell. Markets are looking green, not too green, but we could see that the Dow has recovered the pre-announcement kind of selling that was going on there. As for Bitcoin, literally right in the same range that it's been in. XRP back above 71 cents, as someone said, just absolutely mooning. Yeah. We have mostly green throughout the market, but we can see very slight green. Most of these greens have a 0 on the front side, so less than 1% to the upside today. But we are having things slightly turn green. Just remember, this thing can get wacky and wild. No telling right now. Will we see just wham to the downside, or will we say boom to the upside, or we will actually, as we did the last 2 times, total snooze fest last 2 times. We've definitely seen chaos, but we actually had a pretty big snoozer the last 2. Even though it was the pause last time. We had the pause last time, and it was still kind of a snoozer. Eric Martinson, man, gifted 5. Thank you, brother. Appreciate it, dude. Bring the chaos. Andy Philpott says, down here. JDV videographer says, sometimes I'm frightened, but I'm ready to learn the Powell of love. Got to be XRP. New backer membership. Thank you, brother. Appreciate it. All right. 6 minutes. Now, as you guys, so just so we all remember how these things go for those who are new and tuning in, dang, Andy, thank you, man. If your name is turning green, look at that. Like, there's nobody who's not green in the chat. That's amazing. Thank you, guys. When Powell goes live, I shush. I stop rambling. I stop chatting. We'll make him much bigger on the screen. We'll watch the charts. You may occasionally in the middle of it see me kind of bounce around like this and do this stuff, where we'll look around at different things, but you won't hear me talking. I'll probably bounce between gold and I'll bounce between yields, DXY and stuff like that. Man, Eric, thank you. The Jake Fu Show, what degree of price action would cause you to bail? I don't know. There's nothing on my mind that's going to make me bail. I mean, you'd pretty much have to just go straight line to 0. I don't know. See, my time frame is super different than a lot. Like, literally, like, especially people in XRP right now, those who like left and then came back and just bought at 85 cents right now, they're emotionally volatile right now. They're all over the place right now. We could go back down to the 50s. I'll survive. I'll be fine. But some people can't. So each person kind of has to figure that one out. If Bitcoin went back to 20K, would you flip bearish? 20K? Man, I don't know about you. It'd be very hard. You know, I'd have to see it in person, but it'd be very hard. Like, that's why the 10 to 12Kers, didn't know what they were talking about. What bullish structure are you seeing that would happen if we went to 10 to 12K? There's nothing. I mean, you're talking doom, right? If you went to 10 to 12K, there was nothing that would have been bullish about that being a bottom. So I don't know. I'd have to see what 20K would look like, but I wouldn't, just thinking of it, wouldn't be too excited, too thrilled about that. But I know the 10 to 12Kers, they were just regurgitating what they saw on Twitter. I know that's all they were doing. They didn't know why. What does the world look like with a Great Depression style crash? Asks Jeff Patterson. Well, Jeff, we've never experienced it before in our lifetimes. So the best thing to do is read up on it. So I tried, during 2020, tried reading up on a lot of it, not paying attention to the Great Depression because everybody focuses on the doom side of it. But I was trying to say, what does it look like on the front side of it? Because it's usually the things that we're seeing. It's usually seeing euphoria. Every mom and dad buying stocks, right? Normal everyday grandmas throwing money into the stock market. And that's precisely what we've been seeing up in here. Everybody's got an account. Everybody can throw money into stocks. Everybody can pick them and throw them and do all that stuff. Aping is culture, right? Like these are the things that you see. All right, so we are 3 minutes away from Jerome Powell. I might even zoom in on these a little bit more so we can look at them a little closer. Essentially, what you are looking at right here is the last 2 weeks of price action. So down here, as we know, Bitcoin since the 13th has just been in a drift. And we know that since the 13th, the Dow has been in a upward drift rather than Bitcoin's downward drift. The Dow's been in the upward drift. We've even gotten through the 702 retracement. We've gotten through the 786 retracement. Bitcoin just not behaving along yet. So when we get live, I might zoom in on these a little bit more just to look at them a little closer. Otherwise, what was mostly red prior to the rate hike, then went slightly green. Now, mostly, still, I'd call it mostly, I call it mostly green. Okay. All right. I'm just trying to get things all prepped because I know we're about to go live in about a minute with Jerome. All right, let me catch up really fast. Oh boy, you guys had a lot of coming in. Oh no, I didn't keep up. Eric, thank you so much. Gator, want to learn how to get your emotions under control when it comes to trading? Check out bcbacker.com. Thank you, Gator. Daniel Gonzalez says, Senor BCB, I keep myself from being SIM swapped by leaving notes on my... What? Where am I? Okay. I can't keep up with it because the chat thing is hiding it. My notes on my carrier saying only, yeah. But I think sometimes they can still get around that. But yeah, it's smart. All right, here we go. We're going to get this going. Rodney, BCB, from following your channel since 2019. Love the content. Don't think I miss a single video. Thanks for all you do. Thank you so much, Rodney. Appreciate it, man. It's generous. Cash Me Outside, gifted 5 BCB memberships. Thank you, sir. Victorious G, 3.4 thousand people are watching. Hit the like button, family. We're at 3.7 now. Steve gifted 1 BCB membership. William Carr, welcome. George Maldonado, thank you very much. Maldonado, no message, but thank you very much. Grumpy Old Men says BCB, United Health is trying for 702. I'll have to check that out later. Trying to get through these. Here comes Jerome. All right, guys, I'll catch up with these after. Here we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a quarter percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path but it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index. And lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but doing performing well this summer. Is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looked good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but, we're going to be careful about taking too much signal from a single reading. And, growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now, after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you are really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think, core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Go to Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Howard.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this sleuth will say.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not,
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates?
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
Steve.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So. In effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Banc of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong, aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is a restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous. And the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. the implication is, we will do what it takes to get inflation down. And in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with, so if you think about both of them as normalization, imagine it's a world where things are okay and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So to continue it, you depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates, but you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark. Hamrick.
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed-rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the the aftermath of the pandemic.
We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
Thank you.
Thanks very much.
Hey, all right. There we go. What a wacky little thing we had there, right? We saw the highest prices in the Dow that we've seen since February 2022 for it to only take it all back. So I don't know if you guys caught the moment when it really started to catch a little bit of momentum there. It happened when he was asked about how long we'll keep restrictive policy. So essentially no rate cuts, definitely no rate cuts in 2023, potentially through 2024. Until 2025. So, or that inflation won't be cutting back down to the levels that they want until 2025. And then you caught it kind of right there at the end on whether or not they're worried about housing and if those rates are impacting it. And that he said believes that housing is still high and that those higher mortgage rates still need to remain intact. But either way, coming off of it, it looks like we're just kind of exactly where we were at before we got the announcement. So we actually got the rate hike right back over here, right there, right? So we are pretty much identical with where we started, just volatility bouncing all around it. As for Bitcoin, of course, up and down. Bitcoin saw the highest price that it's had in the last 2 days, and then boom, rolling over and now right back within range. So no real breaks up, no real breaks down, just a bunch of volatility taking place within there for both the Dow and for Bitcoin. The dollar, though, the dollar did take a little bit of a step down to a new level, but not on a giant time frame, right? This is about a 4-day range in here. We're just now at the bottom end of the range over here for the US dollar currency index. Gold, you might have saw me pop this one up. I didn't have it labeled, so I didn't have enough time to really mark it. Gold, small move, but nothing huge, nothing breakout-ish. Really, markets really look just about where they were before the interest rate hike decision came out. As for yields, any big changes in yields? No, they still look all approximately the same over there. XRP back at just over 70 cents. No big, huge moves in there. I think I may have, and if I miss any of the super chats that happened in the middle of that, I'll come back to them tomorrow morning, guys. I'm going to do my best in there. I saw one in there. Daniel Kenyanzalis, you had said, Senor BCB, I keep myself from being SIM swapped by leaving notes on my with my carrier saying only should this be done with a government ID and in person, which is a good tip. Rodney said, hey BCB, I've been following your channel since 2019. Love the content. Don't think I missed a single video. Thanks for all you do for the community. Thank you very much, Rodney. Cash Me Outside had gifted 5 BCB memberships. Amazing. We still have as the Victorious G had stated, we still have 3.6 thousand people watching. So hit the like button, family. Steve Sokolowski had gifted a BCB membership. William Carr became a new member. Jorge Maldonado. Grumpy Old Men said that United Health was trying for the 702. Sebastian Barros, I feel like the only reason you don't have close to 500,000 subs or more is because your view would become mainstream and God wants us to win. Well, you have to understand what happens like when we're like at the peak euphoria period of 2021 and 2022. If you wanted substantial growth in there, you just keep attracting the audience that wants that. You keep telling it that, you know, Bitcoin's going to moon. You put laser eyes and diamond hands and you feed that, and that's going to attract that audience. So even during that moment, I wasn't feeding that, right? The accounts that did really grew their accounts. Then when you get down to 10 to 12K, bearish accounts, if you were screaming, we're going to go to Doomtown between June all the way to January. If you were screaming doom, like, get ready, guys. We're gonna go down. It's gonna be great. We're all gonna buy it and become super rich because it's gonna bounce lower, right? Those accounts did very well at that time. But since I was bearish for Bitcoin at the peak, and since I was bullish for Bitcoin at the bottom, and we sat at the bottom for so long, it's just natural. It doesn't matter to me. The subscriber count number does not matter to me at this point. It was a huge milestone to want to hit 100,000. That was a big deal for me. It seems highly unlikely we'll ever get to 1 million. It's so far away. I don't even think about it. Just, you know, whatever. I got the little, you know, the little silver play button, and that was the big achievement. But thank you. Kim, I saw you come through a couple of times in there. Thank you so much. Kim589 had gifted 5 BCB memberships. Eden Sedek said, hey, BC Backer, do you think XRP would go to all-time high by the end of the summer or more by the end of the year? Keep up the amazing work. Peace and joy. That is a fancy when moon question. So I'm not sure of the exact timing. We can just look to the price behavior that it's done before, hopefully pretty soon, if we keep moving at the rate that we have for the last 800 days. Annie Philpott, thank you so much. Philpott, thank you very much, man. Rashad Perry, he had gifted a little on-set super sticker. Rashad Perry, a new member, thank you. Andy Philpott with another super sticker. It said behind the scenes. And then Kim 589, I saw you come through here a couple of more times. You gifted one membership, you gifted another membership. Thank you very much. Sebastian Burrow said, when moon, Uncle Jerry, I want car in good condition, right? Thank you, Sebastian. Andy Philpott, thank you very much. Pi with 10 memberships, man. Thank you very much. I saw that. I thought I saw other stuff come through too, but I'm not showing it over here in my streaming software, and I'm not showing it over here in YouTube. So it seems like there's this big gap of about 20 minutes where I thought I saw stuff coming through, but it's not showing up anywhere on here. So I may have to address the last 20 minutes or so of them. XP Market 4 months, man, says BCB sincerely appreciate you standing by when the market was having its own version of bad blood. Now I'm as hopeful as T-Swift at a surprise concert that we're ready to shake it off and groove into good times. Man, you're just speaking my language here. XP Market, thank you so much, brother. All right, guys, we're going to go ahead and wrap this up. How are we finishing off? Bitcoin sitting at 29,300. Looks like we got some green over here in the crypto market, mostly green. So we're sitting off a little bit better than we were earlier in the day. The Dow has sustained itself now that Jerome Powell is done speaking. DXY took a little bit of a spill back down to close to under 101. So we're sitting at 101.02 currently right now. Looking over at the Dow, though, the Dow is getting a little bit of steam back as we get ready to close. Stock market will close in about 30 minutes from right now. But crypto's doing okay after the chaos of that meeting. Otherwise, guys, it sounded to me like, they don't really have any plan for continued raising of rates. They're just kind of going meeting by meeting, but there's no aggressive hawkish talk in there from what I could see outside of maybe just holding that restrictive level for a while, that we won't be seeing rate cuts coming anytime soon. Whether or not this time matters or not, we can look to the last 23 years. The last time that rate cuts happened, hey, those were bad signs. Those were bad signals. So I don't know. I got everybody posting the frogs in here. What does that mean? Are we supposed to be frogging? Do I dare do it? Yeah, you guys are all frogging. Why is everybody frogging so hard? Why are we frogging so hard? Okay. I can't give the people what they want.
It is Wednesday, my dude. It is Wednesday,
Happy Wednesday, everybody. I hope that you all are doing absolutely great. Looks like we just kind of survived that. Hey, Bitcoin, look at that. Back 29,365. Looks like it kind of survived that moment in there. We'll go ahead and wrap this thing up, guys. Hey, once again, I will. Tomorrow is my last day before I'm off on Friday, from Friday through Monday. If you're looking for additional content from me, of course, you could check out my website, bcbacker.com, where we've got over 11 hours of videos that have recently been recorded over here on this brand new course. You can check that out, bcbacker.com. Guys, otherwise, thanks for tuning in with me on this Wednesday afternoon. Happy Frog Day. We're halfway through the week. I'm going to go ahead and wrap it up. Thank you guys so much for watching. Thanks for all your support. If I missed any of those super chats, I'm going to go back and read those and see if I missed any of them, guys. Sorry, it's so busy in these things. But all right, thank you so much. If you could, please like this live stream. Please give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you could be notified of when I create new content and when I go live. As always, this is not investment advice, and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Taylor Swift was mentioned in today's Fed meeting. Have a good one.